Hi everyone, this is Charmi Shah representing Wealth One in our Returns and Beyond podcast and webinar series. So at Wealth One, we do this insightful returns and beyond kind of journey where we have podcasts, webinars, fund manager videos and their views, where we try to bring fund managers and give insight to the investors who are onboarded with us and the audience in general. In line of that, today we have Mr. Shobhit Agarwal, who is the CIO and co-founder of an emerging fund by the name of Grey Sky PMS. So just to give you a little theory about Shobhit, he has been in this industry for about 18 years, if I'm not wrong. And Grey Sky is a very, very new PMS. It's just been some 4.5 to 5 months, but has done exceptionally well. And the track record of the backtested data also seems to be very, very promising, which is what has kind of urged us to bring Shobhit on the show today and hear from the jockey himself about how he's running this entire horse. But before we move on, Shobhit, more about you from your own words, please.
Thanks, Charmi, for having me over. And it's a privilege to, speak on your platform about Grey Sky Capital. As you said, I have close to 20 years of experience in financial services. I was in global markets, Deutsche Bank for 4.5 years, then did structured finance in Stanchart. And in 2018, I moved to Bangalore to work with Sachin Bansal. I looked after treasury for 3 years. It was a 7,000 crore treasury at its peak. And then for another 3.5-4 years, I looked after the lending business within Navi Group. And last year, Apurv and I decided to start something on our own, and we started Grey Sky Capital. PMS is something which you know about. We just got AIF Cat 3 license as well. So we within 6 months, we are a 2 license company, probably 2 products that we'll have.
Perfect. So, Shobhit, the first question that comes to my mind is, of course, about the founders, right? Apurva also is a tech guy. You come from the lending background. What made you guys decide on going into or transitioning into something which is so equity heavy? Because as an investor, my first question is that how do I trust someone who has a very vast background but in the lending space? How do I trust that person with my money to put into equities?
That's a very good question, Charmi. Having worked with Sachin, he will trust you more than you will trust your abilities. And a lot of things in Navi, we were solving through first principles. And I realized that experience is way overrated. Of course, hard skills, soft skills, they're always similar in whatever you do. In Deutsche Stanchart, my background was fixed income. Treasury also, the kind of treasury we were running, it was a fixed income. And lending is also sort of fixed income. But the kind of things we were doing, like risk management, either it's on the asset liability side or on the credit side or on the collection side, it requires you to apply yourself in a similar way. And Apurv has been a techie data scientist since day one, from his college days. And he had no clue about capital markets, except that some of his friends are running, HFTs successfully. So we approached the problem from first principles basis after we moved out of Grey Sky as to what we would enjoy doing, where the tailwinds are maximum, and what 2 decades of India's growth story will present as an opportunity. I was done with lending. I didn't want to do lending because of too much capital requirement, too many people requirement. We wanted to do business which is high on leverage in terms of capital, in terms of manpower, operating, etc. And in general, top down, we like financialization of savings scheme in India, which is savings, household savings moving from FD, current account, to capital markets, equity and debt. So you can do anything there. You can do distribution, you can do advisory, you can do manufacturing. Staying true to our personality type, we thought we will stick to manufacturing. And we have often seen the conflict between advisory, distribution, manufacturing. So we thought we will a house which is only doing manufacturing of our own products. We will maintain tight control and quality over how we present it to our customers. And just focus on performance. That is something which comes easy to our personality, both Apurv and I. So That's the reason we came into asset, manufacturing, or PMS, AIF, in future mutual fund, gift city, etc. And then we started solving problem as to what's the problem with the current fund industry, how funds are being managed, what kind of alpha is being generated, how you are aligning yourself to investors. So all those things that we found wrong in the system, we try to solve it. And we applied similar data science principles which we applied in our previous organization in underwriting, collections, rewards for UPI. And when you are honest to your work, you push yourself accordingly. And we pushed ourselves to the limit where we thought that we are seeing very good results in backtesting, and that's when we launched our product. And so far it's going well for Grey Sky Capital PMS. And when you look around, you will find that most successful equity fund managers come from fixed income background because of the risk management that comes naturally in that stream. Our job is to generate alpha for investors. We don't fall in love with stocks. We are not here to find one best company which gives 30-35x return. We are here to take care of a portfolio, risk manage it, and make sure that on an overall basis, it's doing better than, let's say, everyone else out there.
Interesting. Two things that I think I can pick up from your answer. One, you mentioned about HFTs, right? Does that lead to why you have a quant-based or a rule-based system today in Grey Sky? And second, you also mentioned that you don't fall in love with any companies. I think as a PMS, from what I have read about Grey Sky, you don't fall in love with any asset class in particular, because Grey Sky allocates across equity, debt, commodities, if I'm not wrong. So walk us through the portfolio philosophy and how is it built around?
Yeah. So first question, HFT. HFT is something which as per India's regulations, you have a 2x cap on leverage, and this is not a product which you can offer to public at large. You can't manage, third-party funds at scale. At best, it's something which you can do at prop or close-ended kind of structure. So that is something which we are not focusing on. We want to build a name platform for ourselves by managing third-party funds, and the licenses that we need which are there in our roadmap are PMS, AIF, fund management entity in Gift City, and then the holy grail is obviously mutual fund. So that's how we are thinking about our roadmap. And the second question is around how did we construct this portfolio or came up with this strategy? So I have very strong views around that what creates wealth in the Indian ecosystem. There is no product out there like public market equities, which give you long-term compounding and as well as liquidity. You have fixed income products like, let's say, FD, which is taxed at the highest rate. There's an inflation which is eating into the returns. Debt mutual funds have lost their appeal because of taxation benefit going out. And I don't even want to, let's say, talk about closed-ended funds, either on the private credit side or private equity or VC equity. You are a changed person when you see the return after 8 years, 10 years. So we wanted to build a product in the public equity side first. And when we started working on on our universe, we realized that there are periods when model is negative on the equity market side, and it doesn't make sense to stay in equity. So we threw cash or flexibility to take cash call into the model, and risk return improved significantly. Then it's kind of an insight. And then when we realized that if you can throw in more uncorrelated assets into the mix to equity, you can improve your risk return profile significantly. In Indian context, it's just gold ETF and silver ETF, which has deep pool of liquidity and which you can trade in. And when we threw that into the mix, our risk return again improved significantly, right? So it's primarily an equity strategy where you go long or stay invested in equities till the time they are doing well. But if situation comes like what has happened in Indian markets since last 18-24 months, If you are going through time correction, then it's time to preserve your capital and you move out of equity. We could have moved to gold, we could have moved to cash, but since gold, was showing very strong momentum and it gave stellar results, more than 60-70% last 12 months. Our model shifted to gold and we reaped the benefit either on paper or in terms of live environment when we went live. And that's how we think. If tomorrow we have Nasdaq ETF, which is freely available to invest in the sense they have limits, we would throw that also into the mix. If REIT indeed comes and they have liquidity, we will throw that into the mix because it improves risk return profile. It's not a multi-asset strategy where we are trying to generate highest return for per unit of risk that we take. It's an equity strategy where we are trying to maximize return within the equity universe at an acceptable risk, which is Nifty equivalent. And by throwing these uncorrelated assets into the mix, it's helping our cause. So we are not going strictly by labels, what the strategy should be called. Should it be called multi-asset class, equity? We stuck again to first principles. It is as what is the best thing to do for investors who are looking for long-term compounding, and this is what we came up with.
But at any given point of time, as a PMS, as a fund house, you are comfortable going 100% cash or going 100% gold, something like that?
Excellent question. When it's when you are operating at size, say let's say 1,000 crore AUM or 5,000 crore AUM, and you go bearish on equity, it's a very difficult call to take to move out of equity into cash and gold. And if we look back, probably there was only one fund manager in India who took that call publicly on the cash front and then on the gold front. So and that's why we rely on systematic framework or quant, etc. Because even though you have a view, you will hesitate quite a bit. What if you go wrong? What if it's false positive, right? But if you have a quant and you have high conviction in those models, then you will follow whatever model is saying, and then you take a call, right? There will always be false positives, but if you are on the right side of the trend, you will always avoid these kind of time corrections or deep corrections that keep happening in the market. I find being 100% in cash or being 100% in gold less risky than being 100% in equity. Even if equity portfolio is into 30 stocks. That's what our backtesting results have shown. So yeah, we don't hesitate, we don't worry when it comes to, let's say, capital preservation or risk mitigation.
But exactly like you pointed out, right? That's easier said and done when you are at an AUM of what you are at today, around 60-65 crores. But the eventual goal is to scale up, right? Is to move beyond thousands of crores. At that point of time, churning will be an important factor, right? How do you take care of that churning? Because today, actively churn PMSs also are a big, are scrutinized basically. Investors don't really look forward to PMSs which have a very high churning. So when you scale up to that level, how would the churning be if this same model continues?
As a business person or as a fund manager, when we look at our strategy, the only risk that I have to take care of when we scale up or even today is how do you avoid execution costs or slippages when the size increases or you are dealing in illiquid counter. And that is something which we were aware of when we were designing the strategy. And that's precisely the reason why we started with the large mid-cap universe. You will find a lot of fund managers who have done well at a small case level where you advise and the execution is left with investors. But the moment they come into manufacturing and they start doing it under PMS or AIF, they don't find that kind of liquidity pool and the returns suffer. So we were very clear that whatever we have backtested, we wanted it to be replicated in a real world. And that's why we decided to operate in deep pools of liquidity. So top 250 companies by market capitalization, the smallest company is around 40,000 crore market cap. And gold, silver, given what has happened in last 12 months, there's enough liquidity and enough avenues. There are more than 5-7 ETFs available, 5-7 mutual funds available for you to be able to take call on those assets without slippage and execution cost. So that is something which we have to be mindful of when we scale up. And from investors' perspective, they're smart. They want to see what is their return post fees, post tax, and if the kind of alpha that you're generating, it is coming at a cost of higher incidence of tax. You'll find it difficult to convince investors. So it's always there, not on the back of our mind, but on top of our mind, that are we generating alpha post tax, post fee for investors or not?
Okay. Mentioning about alpha, right? Your calendar year, the first quarter of this calendar year gave about 22% of alpha against BSE 500. But how do you benchmark it against a multi-asset kind of a portfolio? Because if I see, maybe you're the right person to tell me what was the allocation Jan to March, and if it was not equity, what is the right benchmark you're using? Because 22% may not be the correct alpha if I have to actually compare your portfolio holdings to the relative benchmark.
Yeah, that's a good question. See, when we choose benchmark, there are two factors that played on our mind. Number one, there is no benchmark with gold in it when you are a PMS operator. On the equity side, either you can choose Nifty 50 or BSE 500, and then you have got a couple of multi-asset index benchmarks. So both of them will not have gold in it. They will have arbitrage index, they will have REIT index, right? So we have to choose one out of the four. That is point number one. Point number two is that when you are doing data science backed fund management, you can model everything. What we modeled was the risk that we wanted to run with this portfolio, and that risk we replicated as Nifty 50. When I say the risk, I mean drawdown and the volatility. So we are kind of replicating that risk. We don't want to take risk higher than that, and that's why we chose that benchmark, Nifty 50, right? So it was a choice between Nifty 50 and BSE 500. Since we were operating in top 250 stock universe, we thought Nifty 50 is closer, and we are modeling the drawdowns and the volatility of Nifty 50 in our strategy. So that's why we have chosen Nifty 50. Having said that, on our fact sheet, etc., we present our performance against Nifty 50, Nifty Multi-Asset Index, CRISIL Bond Index, and we are happy to be compared with any strategy, any index out there. And our belief is that we should be able to generate alpha or beat any index in any combination. So either you can invest 100% in gold or 100% in equity or in any combination. We should be able to do better than that. Right. So yeah, we are very happy to be scrutinized from that lens. And in terms of how our allocations moved, we were sitting in gold since the large part of 2025. And when we went live on 17 December, we were allocated to gold 100%. And we were lucky that when we were starting, the first month gave 20% return. Gold has never seen that kind of rally in a single month. Right. And it to be our first month. Then came February, hugely volatile month. Gold corrected quite a bit, and there was very strong, buying undercurrent in stocks. Even though Nifty may have given, flat return in February, but a lot of stocks in the broader market were moving up, and that's when our models started shifting from gold to equity, and the transition got completed by March. And in April, we saw again a big recovery in equity markets. Gold stayed flat, but we were able to reap the benefit when equity markets going up. April, we were up around 13%. So far, May has been pretty good. Markets are flat, but a lot of buying in mid-cap space, small-cap space, and our strategy is up around 7.5% in the month of May also. Yeah, it's a short tenure of 5 months, but we have seen the single biggest monthly spike in gold, huge drawdowns in March, then April being strong upswing, May being sideways. So pretty good stress testing of our system and our conviction in the system. And yeah, so far we are doing okay. We're tracking around 37-38% outperformance over Nifty in last 5 months as we speak.
And as a fund house, you don't plan to invest into non-gold metals, non-gold kind of places, nothing related to silver, copper, aluminium, nowhere.
Liquidity is not there, right? But in this strategy, this smart core strategy is positioned as a very core, stable strategy in anybody's portfolio. So we want to stay true to label, no derivatives, no small cap, no micro cap, no credit risk, no duration risk. And if you want to take exposure to anything outside equity, then you have absolutely nothing other than gold and silver ETF. And yeah, if tomorrow, as I said, if tomorrow there is liquidity and flexibility to invest in NASDAQ, it's a good asset. We will throw it into the mix. So for us, we are not limited by our knowledge of any particular company, sector, macro. We can model everything.
Fair. What is the allocation today? As of today, how much are you invested? Are you 100% into equities, or you're sitting on cash, or what is it today?
Right now, we are 100% in equity. Equity markets, people may be complaining that it's not giving return, etc. since last 2 years, but very strong buying happening in a lot of pockets within market, and yeah, they are doing much better than your precious metals, and of course, better than you parking your funds in liquid Bs or liquid Ks.
Correct. So which are the 3 sectors you're betting on right now?
See, the models that we have built, they are reactive. We don't predict outcome in next month or next quarter. And the sectors that we are exposed to, the narratives come post facto. We don't build narratives and invest. We invest and then probably start making sense once you are already invested. See, capital goods, industrials doing very well. They are the biggest, sector allocation in our fund as of now. Then comes metal, not precious metal, but commodities, like Vedanta and so on. And then pharma is doing very well. A lot of pharma stocks in our portfolio. We were invested heavily in PSU banks a couple of months back, but now they seem to have gone out of the portfolio. And our exposure to banks, NBFCs, etc., is almost negligible. And of course, no IT related stocks since they have not given return and they haven't done well. So pharma, metal, industrials together, they would be around more than 55-60% in our portfolio.
Superb. So anyone who comes in today, is there a model portfolio that you follow, or is it customized based on when the investor is putting in money? For someone coming in today, how soon will the entire capital be deployed?
Yeah, 2 different questions. We follow one model approach. We don't customize portfolio for different customers, except if something is in their restricted trading list.
Correct.
As a fund manager, I take a lot of discretion as to how do we deploy, and that depends on drawdown of our strategy, drawdown happening in a broader market, and sometimes client also has a preference as to to be deployed over 1 month or quickly. They want to get exposed immediately when they send money. So a lot of these things decide, right? If customer leaves it to me, then probably we will. I think markets are good to invest at these levels, and I will probably deploy it over 2 or 3 tranches over 5 to 10 days.
Okay, that's very hopeful to hear that we're still deploying. Perfect. So moving on, or taking a step back, I would say, to the backtest and the model itself. What was the team like? How long did it take to form the model? And how far does the backtest go? And where has it failed? And what was the trigger? And what were the triggers that probably enhanced it?
Yeah. So Chami, when we were designing model, we were trying to address a lot of issues which I faced as an investor. Let's say when I came into money, and where do you put money? And there are two things which I realized, that investors' persistence to stay with any fund or fund manager uh, is directly, related to fund managers' consistency in delivering returns. And there are so many examples in West and in India where fund would have given stellar return. Some staff fund manager quoted that particular scheme gave 20% CAGR over 2 decades, but only handful or single digit investors were invested throughout the period. So what happens is that these funds, they go through cycles. They, of course, over a period of 20 years, they would do very, very well. But there are certain stocks or there are certain cycles where they will do well, and there will be periods when they will go through a rough patch.
Correct.
There are again so many studies where you are in top quartile and then you slip to quartile 3, etc. And then it tests patience for investor, right? So both have to be blamed. Investors have to be convinced about the fund manager, and their conviction comes from consistency of the house. So we wanted to be very consistent in terms of whatever we are doing, and that consistency itself can take you to top decile in terms of performance. So when we were designing a strategy, we made sure that we are ruling out those strategies which were giving a lot of spike at certain point of time, and our go-to metric apart from risk, etc., is how well do we do on a 3-year median rolling basis compared to benchmarks. And if we are outperforming benchmark in maximum number of instances, then that's the strategy that we deploy. So yeah, and so once your objective is decided, your universe is decided, your constraints are decided, then it becomes a matter of compute and how far you can go to achieve your objectives. And that is what we have done with our strategy. It took we started working on it from April, and finally we got something which we really liked by September. That was our generation 1 model with which we went live. And then it's a constant work of research, like it's there in fundamental. We found a lot of new features over last 4-5 months, and we saw uplift in risk return. And now we have deployed Gen 2, which is showing better numbers than Gen 1. So it's like an operating system update. You keep doing that apart from your frequent interval refresh of the models. So right now we are with Gen 2 of the model, and in terms of team, we are 8-member team. We always want to be lean, even when we are managing $1 billion corpus. We don't want to be managing too many people, and that's the reason why we started this business. And on the data building, data modeling side, etc., it's Apurv who does heavy lifting. He's my co-founder, and of course I come up with a strategy, universe, risk return trade-off, etc. And then it's a joint exercise that we do.
Correct. I mean, yeah, if Zerodha's core team can run with a 20-member team, I'm sure most of us also can. But interesting to know that, your vision about $1 billion is in place, right? But intentionally, is there AUM cap that you are looking to place on this particular PMS, or you're open to as long as, you can run it?
No, we don't want to scale it at a cost of alpha to our investors or customers who have invested us with their money. Today it's not backed by data, but the sense is that this particular strategy at current market cap can absorb maybe 7,000, 8,000 crore of capital. We generally construct a 30 stock portfolio, so that's how you know how much per stock exposure you will take and what kind of liquidity is there for you to enter and exit. So, right. But again, the beauty of the data science or quant modeling, etc., is we can develop other models which will have entry exit at different point in time. So you can have another strategy. As a house, we are very clear that we will not have 2022 products on our shelf. One doing better in some season and the other one doing better in some cycle. We will have limited products. This is our flagship product and probably the only product that we will have in this space under PMS format. We'll have something unique in the AIF format. Then we will have something unique in Gift City. So we want to be known for excellence in wherever space we are operating in. And I have my inspirations from the market, and those who are like, they always package their best into one single product and present it to the market. So we are taking that approach.
I think it's better to have more returns than more number of funds. I think investors also love that kind of an ideology when it comes from fund managers, especially those fund managers who are actually founders as well. And it kind of rings a bell with the insight or the philosophy of running that particular focused fund house. But talking about, the fund manager and the employer or the founder being the same, I want to understand what is your skin in the game. And I ask this not from a very layman perspective. I ask this because when I was reading your fact sheet, your fund deck, I came across the slide on backed by and a lot of names on the cap table that you have. Makes me wonder, why does a quant based PMS need VC funding? Why do you have a cap table?
So yeah, that's this PMS is one of the hardest license to get. You have to go through inspection. You need regulatory capital of 5 crore, and then you need expenses till your fee income starts kicking in. So there is always front loading of expenses. So you need capital right from day one. We put significant capital as an equity in Grey Sky. And then we wanted to have a group of angel investors who we can tap when we, grow in size in terms of augmenting our AUM. And we wanted to raise small amount, but we ended up with a slightly higher subscription. And we have diluted a single digit in Grey Sky Capital to raise that money. And now it's our duty to provide to obviously, generate wealth or returns for these shareholders. So there is a cap table, but we don't talk about it, or in the sense we have not done any announcement around it. Whatever we needed to raise as a capital, we raised it, and we are running the business. So that's about cap table. And skin in the game. All our personal money is invested into our, these strategies, and significant amount of Grey Sky Capital money is also invested into this strategy. And now, if you look at our fee structure, that is something to talk about. And there is been a lot of discussion and debate around, 100% variable fee structure, where hurdle rate is 0. If client is making 10%, they will take 1%. So we have seen these things, and of course, any smart person can see through as to what's happening in the market. If you look at our fee structure, we just have one fee structure, and all clients are on the same fee structure. We don't give any discount irrespective of their size, relationship with us. And we have said no to large checks because of the ask for discount, etc. But we know once we set our brand, set our principles, people will not have to look over their shoulder as to somebody is getting a better deal. And our fee structure is less than 1% on the fixed fee side, which we get. And we have a hurdle rate which is one of the highest in industry. It's 12% fixed, and on top of it we give an option to investors to choose either a fixed hurdle rate, or they can choose Nifty 50 as a hurdle rate if they, and it's a behavioral choice, because Nifty has over a long term given similar returns. But if you're tracking a market and Nifty gives 20%, then you always have this doubt that how much alpha you have generated. So for those set of investors, they can choose Nifty 50 as a hurdle rate, and then we have a profit sharing. So we only make serious money when our clients make money, and that's another way of showing, our skin in the game.
Making money, skin in the game, all these come into the PMS part. But let's first of all, congratulations on the AIF license. I heard about it last week only. Tell us more. Is it going to be the same strategy? Are you going to have a different focus over there? And when do you plan for a gift city license as well then?
So first is AIF Cat 3 license. We need to do our first close. We need to stitch a lot of things together, launch it, and then we'll obviously go for the third product. So right now focus is on setting up the AIF product. There we have expanded our universe from top 250 stocks to 500 stocks. We are bringing same principles of equity, and if equities are not doing well, then how do you move to gold, and ability to take cash call. And then given that it's an AI format, you get some leverage. You get flexibility to go up to 2x of NAV. So we will use that leverage to augment returns further for our investors. And also, we will include elements of tail risk hedge, which is event like what happened in March. So these are tail risk, right? When markets don't give you warning and they just suddenly crash. It's an event which happens generally between 4 to 5 years, at a gap of 4 to 5 years. Last we saw in March, even before that was in COVID. So, how do you hedge those risks to prevent further drawdown? So we will include all these bells and whistles and bring it as a package. AIF is a pooled vehicle. It allows much better flexibility to manage funds and derivatives compared to PMS. So it's if Smart Core is a core strategy for anybody's portfolio, AIF is being positioned as a high conviction satellite bet, and it's obviously for HNIs, ultra HNIs. Minimum ticket size is 1 crore there. So that's what we are working on.
Talking about these tail risk kind of events that you mentioned, right? How has your quant model and the backtest worked out when it came to those kind of events, say 2008 or the 14 crisis or the ILFS event or the 2020 COVID crash? Did the quant, seemingly discount in for that, or what was it like an exceptional return that you had at that point of time?
Yeah. So our current model, it handles, prolonged bear phase or a gradual transition into, time-based correction, price-based correction very well. It moves out of equity and preserve capital, and it has done that pretty well in last 2 years. In COVID also, COVID didn't happen overnight. Markets started reacting from February, and we saw our drawdowns limited to whatever 25-26% compared to 38% in Nifty. But so there are two things. If it's a flash crash, like an overnight news comes or things start moving very quickly in a span of 1 week, then models will go through their drawdown, and for their to protect yourself from those kind of drawdowns, you need a different strategy, or you need an overlay or a cash strategy. That is something which we are working on. That's not part of our current Smart Core offering. And phases when we don't do well compared to market are when let's say neither equity nor gold, they are not able to find direction and they kept whipsawing. Something which we have seen in 2018. We underperformed Nifty. Nifty was down probably 3-4%. We were down in double digit. And when we go and look back what happened in 2018, default happened from a couple of large NBFCs. Then categorization of mutual fund happened in that year, where a lot of reshuffling happened by mutual funds into large cap, mid cap, small cap. So we didn't do well in that particular year. So if a year like that comes where neither equity nor gold, they are not able to find direction and they keep going up and down, then our market will go through drawdown sharper than market. And otherwise, prolonged drawdown, etc., we will be able to, navigate the markets better than Nifty.
Fair. But are you completely okay, or are you completely 100% quant guy? Or the philosophy has the last 10-20% is actually a human research team that is sitting on it and, kind of vetting whatever the quant checks out. How is it done end to end with respect to this PMS?
See, the reason why we are doing quant is not because it's fancy. In India, quant share in active fund management is 2 to 3%, while invest it's 35 to 40%. So it's still pretty early for quant in India. We are doing quant because of our conviction into this stream, and Apurv obviously has been there, done that for long. But for me, when I was in my previous organization, I saw how small or big problems are getting solved through data science, and how these models, beat humans almost on a daily basis when it comes to underwriting, when it comes to any other, overlay of rules. So once you have that kind of conviction, then last tail 10% of human judgment or management, etc., is all futile. You may win 1 or 2 times, but on a long enough time frame, you will always lose to machines if you have modeled them properly. So we come from that school of thought, that kind of conviction. So we don't waste our energy in using our discretion, etc., when it comes to what model is saying.
Understood. Fair. What is the journey ahead? How do you look at it? I know there's an AIF, there are future plans, but apart from that, what is the team focusing on right now?
Right now, focus is on in this, as a business point of view, there are only 2 levels. One is performance, and the second is AUM. Generally, AUM follows the performance, and then to insulate the business from the volatility of equity market, you would like to have more products which are not completely correlated, so that there is a stable revenue stream, business point of view. So our idea is that over next 3-4 years, we will have 4 to 5 products, and hopefully they will be not correlated to each other. So you have that kind of stability when it comes to revenue stream, and keep building trust, brand, confidence, etc., on our platform. Once each $1 billion plus kind of an AUM with 3 to 4 products, and there is decent set of goodwill that we have generated, then it becomes a platform play. Grey Sky Capital will be known as a good quality manufacturer, and then whatever your clients need, if they need private credit, or if they need something else like an infrastructure fund, then you create a team, put it together, and launch it. Right? We want to be able to offer something to everyone. That is our vision, and we haven't forgotten about the retail piece of it. We constantly keep thinking about what we can do for those who can't come up with the 50 lakh ticket size, which is required for PMS. So idea is to have something for everyone, and that's what we are working towards.
Really love the way you keep on stressing about the $1 billion AUM in almost every answer. I hope you guys achieve that, man. But let's take a flip side of it, right? Because I'm known to be the devil's advocate at my firm. So let's take a flip side and understand or think about it, that if for some reason Grey Sky fails today and something happens, what or who would you blame? Would you blame the model? Would you blame the AUM? Would you blame the structure of the firm? Or would you blame the non-equity founders? How would you put it?
Blaming is done by weak people. What strong people do is they will fall and they will get back. You will try to figure out what was the shortcoming. You can never models, right? We have created these models. So you have to go back and iterate and see what did we miss, right? There is absolutely, no one to blame, and the only thing in your hand is to get up and make it work. That's what we have seen. We have solved so many complex problems, when we are in Navi, and that's what we carry forward, right? So there's no reason for us to believe it will not work out. There is, so much flatness, so much mediocrity in the market right now that right now we haven't used AI ML in our models. These are statistical models. So much of improvement and work that has to be done here. So we don't. Every day we feel more optimistic about future.
Let's stick to India. How optimistic are you? Where do you see the markets, say, short term this year end and maybe by 2030?
That's a question for star fund managers to answer.
I said, no, I want you to answer it. I want to understand from a quant fund manager as well.
No, Charmi, as I said, our models are reactive. Our job is to maximize return from the universe that we have chosen. Right? If tomorrow the whole large mid cap space is not giving return, gold is not giving return, we will also be flat. Why we are in India, why we are doing this is because we are optimistic about everything that India has to offer in terms of long term, medium term, short term, and things go through cycle. I don't blame taxation regime, etc., for whatever is going on. If you look back, if you look at last 3-year CAGR, last 5-year CAGR, they are not bad. You go and sort PMS fund managers, return wise, and you will still find a lot of them giving 30% CAGR for last 5 years. So it goes through cycle. You can't have a period like 2021, 2023 all the time, right? So yeah, you have to go through these, and those who are nimble, agile enough, they will figure out pockets where money is to be made. Again, if you look at last 1 year returns for a lot of the fund managers, a lot of those guys have generated good returns. So we want to be someone who is generating returns constantly through every cycle if return has to be made, and that's how we think about. We don't blame regimes. We don't blame what's going on around us. It'll keep happening.
Okay. But blaming aside, where do you see markets in general? Are you bullish? Are you bearish right now? What is your stance?
So we, when we model, we have microstructures in market. There's a bull phase, there's a bear phase, there's a sideways movement. As per our model, we are in a bull phase. That's why we are 100% invested in equities. Okay. So yeah, I'm pretty excited to go to office every day because of let's say whatever is happening in the market. Very strictly speaking, in a very short term sense. So yeah, we are pretty bullish, and that's why we are 100% in equity. That's our gauge.
I think that's a very good note to end the webinar on. It's a very hopeful and a very affirmative note. So thank you, Shobhit, for being on this webinar. I really appreciate it. And it's just a small disclaimer to our investors that we discussed a few sectors here and there. It's not an investment advice. Please have your own research and consult an advisor before investing. Thank you, Shobhit, again for being a part of Returns and Beyond at Wealth One. See ya.
Charmi, thank you for having me over.